Welcome everybody to the latest episode of the T3 Alpha Show. My name is Michael Comeau, and I am happy to introduce you to Ted Zhang. Now, Ted was going to be an oral and maxillofacial surgeon. He was going to go to Columbia to become a surgeon, and to my knowledge, Ted, you thought surgery was like way too easy, so you decided to tackle Wall Street. Is that true?
Of course. Surgery is too easy. The markets, it's always changing, and one of my favorite quotes is that the markets is like a puzzle, except the puzzle pieces are always changing. So as a trader, as an investor, you always have to adapt and stay flexible to just all the variables that the markets presents day in, day out, week in and week out.
Okay, so you were studying biology in college, and then it sounds like you sort of had an epiphany, like, I want to move into finance, I want to be attached to the stock market. Like, what led to that transition?
Yeah, so I matriculated into the College of William & Mary fall of 2019, studying biology on a pre-med, pre-dental track. And as you guys all know, COVID hit that spring of 2020. So we all got sent home after spring break and never returned to school for, I believe, at least 6 months. And during that time, COVID crashed the markets. That's when I was introduced to the market. So you can call me a COVID trader, but one of the COVID traders that survived. Many didn't. And that's where my passion and interest started in the markets. And ever since then, I've read so many books about the markets, listened to so many podcasts, of course, trial and error in my own process, developing a process and system. And just over the years in college, studied the markets and trading alongside all my biology, chemistry, physics, all the other classes. And then when it came to decision time, and we can get more into that in a little bit, Michael, if you have any questions, I decided to drop my acceptances and head into the path in finance.
Okay, now, Ted, my mother, when I was your age, my mother got mad at me because I didn't want to take the citation test to become a New York City garbage man. Was your family, like, annoyed at you?
No, so all my parents wanted was me to finish the path, since I've already committed to this long journey. And by that time, I already took my dental admissions test. I did really well on that. And when the decision came, I only had one semester left. So they wanted me to finish it out and get the acceptances. And then they said it was all up to you, what you want to decide. So they're actually quite supportive of it. Surprisingly, you'd think.
No, that's amazing. I mean, sometimes I hear the total opposite, like people go off to pursue their dream and they don't really get support. So that's amazing that they really stood behind you. Okay, so now you are 24, I believe. You're a portfolio manager at Revere Asset Management, managing $20 million. Now, to my knowledge, like, it's not easy to get hands-on actually managing money, especially early in your career.
Right.
So how did you pull that off?
That is correct. I got really lucky. Like, my style of trading, I'll just quickly introduce it. It's a combination of, like, looking at the strongest themes in the market as well as catalysts. And from my studies of the biggest winners in the stock market from a trading perspective, all begin from like a news or earnings catalyst, whether it's an earnings surprise, company raises guidance, huge beat and raise, some sort of maybe government regulatory news. With the nuclear names, you had Trump's executive orders. And so essentially my process is a catalyst and thematic trend following method. And
okay. So did this...
really... And so I was just going to say that strategy fit exactly what the firm wanted to see. And I already had multiple years refining my process. So right when I joined the firm, shortly after, our bosses carved out pieces of their own money for me and my friend, who we co-managed a portfolio with, to trade. And we started showing that we could handle other people's money, manage risk, cut losses, and we just showed our bosses we had a process. And eventually we were able to get our hands on client money.
Okay, that's awesome. Okay, so how did you develop this strategy? Like you said, read a lot of books. I saw you were recently at an IBD conference. Like, so are you a follower of like the William O'Neill method?
Yeah, that's part of it. I've definitely I'm not a religious follower of his method alone. I've combined a bunch of other people's methods. Like you might be familiar with the Swedish trader Kuala McGee. He's one of my favorites as well. And then I've taken aspects of Druckenmiller's philosophies into my trading too. Although we're not really global macro. We don't trade currencies, fixed income, in commodities, just mainly in equities. And some of the books, the Market Wizard series, that was a big inspiration, of course, like you said, William O'Neill's How to Make Money in Stocks, Jesse Livermore, Nicholas Darvis. And I've read some of the value investing books, and that just helped me gain understanding of different philosophies in the markets. But I'm primarily a growth trader, growth and momentum trader.
Okay, so when we were speaking offline before, you were talking about how Revere wants to disrupt traditional asset management. So, like, I'll put you on the hot seat right away. Like, why would people go with you? Because we always hear about how hard it is for fund managers
Right.
to beat the market. Plus, like, active
Right.
management is more expensive from a fee standpoint. So like, what answer do you have
Right.
for doubters?
And this is why. So most of our clients are heading 40s, 50s, and older, heading into retirement or are in retirement. And the feedback we constantly get time and time again on our YouTube videos, in the comment sections of our tweets, and in our emails is that they can sleep well at night. And to back up real quick, most of our clients are from these, let's just call them traditional advisors, where you give them some money and they ask if you're passive, you're somewhat aggressive or aggressive, and then they just have a computer model that puts you into mutual funds or a basket of stocks. And most of the time, they just stop watching them. They're on to the next client, opening the next account. They might be on the golf course closing other clients, and they're not looking at your portfolio anymore, managing the risk. And the stats are that once in every 4 or 5 years, the markets experience a bear market that can drop 20, 30, 40%. And that is why clients come with us. And even though they pay a higher fee, they don't want to see their nest egg in retirement, where they have to really rely on their nest egg to produce a return to live off of, because they don't have an income anymore. And it's just very hard mentally and financially to experience any 30, 40% drawdowns.
Okay, so I'm not going to ask you to reveal any kind of like secret sauce or anything, but like, do you have a general methodology for determining the strength of the market? Because
Yes.
we hear a lot of people saying, "Oh, we're going to zoom up," or "We're about to crash." So
Right.
how do you assess the overall market?
Right. So we put out a daily video every day the market's open on our YouTube channel, and how we assess market health is based off 4 variables. The market leaders, and for those not familiar what that term means, it's just the leading stocks in the markets showing the most relative strength to the S&P 500. They're typically the strongest and most liquid stocks in the most dominant themes and groups of the market, trending above all key moving averages. The other 3 variables, a short-term trend, and we're usually based off of using the 21 exponential moving average on the S&P 500, NASDAQ, and small caps, as well as the Dow. But mainly the S&P, NASDAQ are the 2 big weightings in that trend gauge. And then the medium-term trend is based off the 50-day moving average of the major indexes, and then the 200-day moving average. And with all 4 of those variables, the health and breadth of the leaders, where the indexes are trading respective to the 21, 50, and 200-day, we have various rules of exposure and aggressiveness, as well as position sizing.
Okay, and like, how did you come to those moving averages specifically? Because we hear some people use the 10 and the 20, or the 20 and the 200. Like where did you actually get those numbers from?
So yeah, you're right. Like the 200-day moving average is really just the typical long-term trend that many institutions and people look at. And when a lot of algos are based off the 200-day moving average, and most people are looking at the long-term trend, then it really matters. People say technical analysis and using these lines is voodoo, especially from the fundamentalists. But if you have enough people in the world believing in it, it matters when people base their systems and algorithms off these various levels and moving averages. The 50 days, again, it's a very classical medium-term trend indicator on the charts. That's why we use that. And the 21 EMA, it's quite synonymous with the 20-day, but we just chose the 21 EMA since it is a little bit faster, it catches up to the price quicker. And we've done some studies, and a lot of moves, a lot of uptrends are contained by the 21 EMA. And once you're below it, it gets much choppier and harder in individual stocks, and that is where volatility oftentimes starts increasing.
Okay, so what have been your big themes this year? You know, we see like uranium, gold, semiconductors, Bitcoin, like even utilities are picking up. So like what have been the themes you've focused on this year for your clients?
Right. So coming into this year, I mean, the biggest overarching theme of the last 2 years has been artificial intelligence. And when you have this main theme, if you visualize that theme in the center, you have concentric circles coming off of it. And from that, you already named a bunch of them. For example, utilities. And in utilities, I could also break that down, for example, into nuclear that helps power many of these data centers. So, and then from nuclear, you have like nuclear fuel, you have SMRs, even though they might be in research and development. You have names like CEG as well, which is a utility. And so overall, the theme for us has been artificial intelligence. And from that, you have the power generation areas, you have the data center areas, and then you can distinguish between chips, you have memory, you have networking. So all those areas have been a focus for us in this year. And then, like you said, Bitcoin, crypto as well. We have some exposure in those areas too.
Okay, like, do you have any concerns about the market being in a bubble? So the latest thing I noticed on Twitter, everybody's attacking like the quantum computing stocks because they have like
Yeah.
they have like $400 in revenue and a $20
Yeah.
billion market cap. Like, so overall, like, do you see any signs of a bubble out there?
Definitely. There's definitely signs of a bubble out there. Like we know that PE ratios are historically super elevated. You have, like you said, these quantum computing stocks with almost really no headquarters, no product, nothing, revenue probably less than our like the corner grocery store by any of our houses. So that's definitely concerning. But how I like to frame it is that there's traders like myself, and then there's also investors, and you can't conflate the two. If you treat a trade and then starts turning around on you, and then you say like, oh, I'm just gonna invest in it now, that's where a lot of losses can come from. And from my perspective, in trading perspective, we love bubbles because the moves can be extremely fast on the upside, obviously as well as the downside. But we have rules to get us out before those losses come. And yeah, from a trading perspective, bubbles can come with the fastest moves and the biggest moves in the shortest period of time. But bottom line is, yeah, there's definitely signs of bubbles forming. People are starting to get a little complacent. But we don't like to predict that, Revere. We just like to follow what the market is doing right now. Again, guided by our various indicators, what the market leaders are doing, and we'll continue riding the wave until things stop working.
Okay, so did fundamentals like play a part in your like? Are you so? I guess I should have asked this question a while back, but are you picking individual stocks or are you just using ETFs?
A combination of individual stocks and ETFs make up our portfolio.
Okay, so are you? So it sounds like you use a technical overlay to judge trends. What are you
Yes.
using to actually pick individual stocks?
Okay, yeah. So our perspective is technicals first, but adding onto those technicals, we look for themes and that and for reasons for why the stocks are going up. But we do consider fundamentals as well. Of course, we love the triple digits earnings and sales year over year. We love to see companies beat and raise in their earnings reports and guide much higher for the future. But at the end of the day, technicals comes always first. We like to distinguish between a good company versus good stock as traders. A company could be the best company in the world, but their stock, if it's in a downtrend, we're not interested in that company or that stock at all. So I want to decipher that and be clear that there's a difference between a good company and a good stock as well for trading. And really, I like to coin this term magic elixir, which I've tweeted about. And we want to look for stocks that are liquid, high ADR, because we don't want to trade slow names. We want a name that when it gets moving, it actually moves. So high ADR, usually at least above 5%, or you can use ATR, same thing. We want a stock that trades linearly. A choppy stock, it's like a bucking bronco. You can't ride that to the other side. So if it's choppy and you get shaken out, it doesn't matter if it goes up 1,000%. You might not even be in the stock. So we want linearity, a stock that respects key moving averages in the past, likes to make new highs without a lot of reversals, bearish engulfing candles, stocks that mean revert to the 50-day and then hit highs 2 weeks later. Those are stocks we want to avoid. We want stocks that have shown they had previous history of making big linear moves on big volume as well. Ideally, you can find that many of the biggest moving stocks come from a highest volume ever daily candle. And oftentimes that's paired with a catalyst. And so that's something we want to look for as well. Catalyst, theme, and then a nice big weekly chart is usually the best to catch a sustainable move, and then a tight daily chart for that precise entry.
Okay, so are you using, like, when you're actually making entries, adding new positions, like, do you have a very strict set of parameters? And I ask this because I speak to so many people that, they have their rules, but it also seems like they break them on a fairly regular basis. So how rigid are you in this structure?
So we have different types of entry tactics. Like we buy strength and buy pullbacks, but in terms of pinpointing exactly like a metric that causes us to buy, it's more of first identifying the main themes in a company with a catalyst and good numbers as well, and that's always a bonus, the good fundamental numbers. But we'll buy pullbacks to moving averages as they turn up. We'll buy like a base breakout, just like if you have a flat level, like let's say that NVIDIA breakout early 2024. I believe now it's post-split is around $50. That huge multi-month base. And you can see that every time it got to that level, it starts reversing. But the stock builds higher lows and it gets tighter and tighter. And to that, reading supply and demand, it indicates that strong hands, institutions are accumulating the stock off weak hands that are dumping it. And eventually you cross that line of least resistance. It was that $50 level back in early 2024. And then NVIDIA goes on and makes a 90 to 100% plus move. Of course, it'd be easier to show exactly what we want to look for with a chart, but I'm just trying to describe one of our bigger winners in the last couple of years and how we analyze charts.
Okay, so it definitely sounds like you are well into AI, because you were also talking about like the data center plays, the power generation plays. Like if you had to guess, what inning are we in for AI? And I'll preface this to say that like 2 years ago, I thought we were in the 6th or 7th inning, and now like I see the the AMD OpenAI deal, and I was like, maybe we're in the second or third. I mean, I know it's hard to like really think too far out, but like,
right, it's really hard to predict because it is really hard to predict. And our motto at Revere is we don't ever want to predict as traders. We just want to react to what the markets give us day in and day out, week in and week out. But if you were forcing me to predict, I mean, it's really hard. I'm quite skeptical with this paper churning of money around between NVIDIA, Oracle, AMD, and OpenAI. For example, NVIDIA invests $100 billion into OpenAI, and now OpenAI is taking that money and doing a deal with AMD where they get the opportunity to buy shares like up to 10% of the stock of AMD. So does that mean NVIDIA essentially owns AMD as well? And then today we're seeing some weakness in the markets, partly because Oracle reported that they've actually lost some money on their Blackwell rentals just a few weeks after some huge CapEx guidance and revenue guidance in the earnings report. And we've seen this behavior before in the dot-com era where the companies just start striking deals with each other, raising guidance, announcing massive CapEx. And the key is, does that huge investment actually lead to earnings in the future and productivity enhancements that are justified by the hundreds of billions, and sometimes Sam Altman has said investing $1 trillion over the next few years into AI infrastructure. So I don't, it's hard for me to predict. Like, we just want to ride the market leaders in our short-term, medium-term, long-term trends of the markets. And we're trend followers. So as trend followers, you don't really ever predict. You're never going to catch the last eighth of the move or the first eighth. We're just trying to get that meat portion in the middle. Okay, and we don't know how large that meat is.
Yeah, absolutely. And I do think the dot-com comparisons make sense. I mean, back then it was just called like vendor financing, where if you're Cisco and I'm whatever herky-jerky internet company, you loan me $100 million, I buy some servers from you. Yeah, but the numbers keep getting bigger and bigger. It's I mean, I don't know if you remember, like when the CoreWeave IPO flopped, nobody wanted it. Right. And then within a week, it's all the races. But I mean, it's also like we can't just say this will end badly, because when is the most important question. So
exactly.
So since we're on the topic of AI, are you using AI tools to help you in your research and your trading?
Definitely. I use Perplexity a lot for financial research. Perplexity is probably the best because their query is able to scrape the internet for the most up-to-date information. I've used ChatGPT, Gemini, Grok, Claude, and sometimes they just get up-to-date information, like very, very recent information, completely wrong. And so I use Perplexity a lot and the Comet browser, which has the Perplexity assistant right by, and I have some shortcuts that I'll use, and I'm happy to share them I can send to Michael and he can include the comment section if he wants. But it's just a quick shortcut I use, and it tells me, explains a company like I'm 12 years old. It gives me a more professional description, a news timetable of the last 3 months, date, what type of news, what happened on that day, the price percentage of stock went up, volume as well, various catalysts that happened in the past, and then potential catalysts in the future, and just a really nice synopsis of a company whenever I'm screening and I see something that catches my eye.
Yeah. So I'm actually really, really glad you said that because I've used GPT for more like content tasks, but even just last week, it told me that the all-time high in the S&P 500 was 400. And even like I'm asking, "Are you sure?" And they're like, "Nope, it's definitely
Yeah.
4,400." Because it is interesting. Like, do you think does it allow you to do things you wouldn't have been able to do before?
Yes, I can get I can get a good picture of what a stock does and that whole news timetable in one area within a minute or less, versus before I'd have to be scrolling like 5, 7, 8 tabs. It'd take me a lot more time to understand a company.
Okay, like do you use any other more traditional tools like Bloomberg or FactSet or anything like that?
We don't use Bloomberg. We use like briefing.com for news. We also use a smaller one called Fly on the Wall for various earnings, news, breaking news related. No, but we haven't used Bloomberg because we're not that much of a fundamental shop. Like I said, we're trend followers. So to us, the tape, the price action, the charts are first. And then we'll corroborate that with theme, catalysts, and some fundamentals. But Bloomberg was never helpful for us in our process. So not Bloomberg. But
Okay.
FactSet, we do use FactSet as well. But that's through, if you're familiar with Market Surge or as Market Smith in the past by IBD, it's a charting platform with a decent amount of fundamental data, and their data is pulled in from FactSet.
Okay, so you describe yourself as a trend follower. Like what attracted you to that?
To me, trend following is asymmetrical. I mean, well, honestly, like a lot of times as traders and investors, you often become interested almost in one of the earlier things you first pick up on. And I explored value investing a little bit, trend following as well, macro a little bit. Um, Never really explored day trading. It never appealed to me. It just didn't seem like there's that asymmetry where you're holding your winners much longer than you cut your losers for. And so trend following appeals to me because if you follow the trend, you're always going to be on the right side of the market. You're never arguing the markets. I found with value investing, even though there's many great value investors in the world, and some of them are the best to ever do it in the markets, I think that if you're trying to calculate, for example, the intrinsic value of a company, a lot of your biases can go into your model. And if you're not aware of your biases, you can have a wrong calculation, wrong estimate of intrinsic value, and then you're just fighting the markets. And oftentimes value investors are buying stocks that are in downtrends heading into 52-week lows. And if you don't get your biases and your inputs in check, that can lead to huge disasters. So for my personality, I like buying strength as well as some pullbacks into moving averages in a strong stock in the uptrend. So that is why trend following appeals to me. Especially if you're cutting your losses and letting your winners ride, you can achieve multiples of your risk in your trades. And that to me is asymmetrical to the upside.
Okay, so speaking of asymmetrical to the upside, like in terms of your career, like what has your success on Twitter done for you? Because I saw you have like almost 50,000 followers now, and I know it also played a role in getting your career off the ground. So like what has Twitter done for you?
To me, Twitter has been it's really been everything. So let's step back. Like you introduced me as someone in biology. I did not study finance in college. studied biology. I was headed to Columbia, like you said, dental school. And having that Twitter account, I think I was maybe at 10,000 followers back then. First off, it gave me some sort of street creds. It could be false street creds, but it still gave me some street creds, and it helped me land my first internship with a pretty big content platform, Traderline, and they're also the creators of DeepView, which is a charting platform. And from that, I was able to start DMing portfolio managers. And I think if I didn't have Twitter or a following, I wouldn't receive any replies from anyone. So really, it got me my current job and career and being able to manage money. And I mean, the biggest part now is that media is one of the ultimate levers in the world now. So we can get our message across to tens of thousands of people. And once in a while, you'll have that tweet that goes viral. It's shown to hundreds of thousands of people, hundreds of likes, and that really helps us bring in clients and to sell and market our mission. So
Yeah,
really, it's everything. It's huge. It's a huge part of our business and my personal life as well.
Yeah, and I will tell everybody out there, when they tell you that, oh, like the size of your following doesn't count, it doesn't matter how many people follow you, it really counts. If you're smart about it, it can open a ridiculous number of doors for you. Okay, so you decided to make this transition into finance. Now, did you try to go down through like the traditional Wall Street recruiting methods? Like, were you applying to Goldman Sachs, Morgan Stanley, those types of
No,
firms?
I didn't. All my friends were applying to those firms, but none of that work really interested me, and I couldn't trade my personal account. So that was off the table, like almost immediately. You know how like at the big firms, you have to go through compliance for every single trade. And then after you make the trade, you have to hold for like 3 to 6 months. So when I knew about those rules, like that side was completely off for me personally.
That's interesting. So have you always been very much kind of an individualist?
I think so. I really value my freedom and independence. And at this firm right now, I almost have full agency over my work and the trades that we do for clients. Being at this age, that's huge. And honestly, it is probably not heard of traditionally. So my friend and I who co-manage a portfolio, our bosses gives us so much freedom in our decision making and agency. So I definitely value that.
Okay, so is it hard to co-manage? Because I mean, like, does it ever feel like there's too many chefs in the kitchen?
With two, not really, especially since our style and our view of the markets is very similar. And actually, it kind of bodes well because he does like my colleague does like to buy pullbacks a little more, and that is a great way to like get that starting position at a lower cost basis into the stock. And personally, I like to buy strength more, so I'm more of like that person that's pyramiding onto our position as the stock works. And so far, our two styles have meshed well, and it's led to pretty decent results.
Okay, so like when you were first actually managing client money, was it nerve-wracking, like hitting the buy button for the first time?
Yeah, definitely a little bit, but really quickly, I kind of just got used to handling that pressure. And honestly, at this point, I find it easier sometimes to manage client money than even my own. I don't know why. It's maybe I'm too attached to my own money sometimes, and that ironically or paradoxically makes you sometimes make worse decisions versus I do really care about my clients, but it's not exactly my money. So I'm able to be like have that carefree state of mind that's really crucial for a trader to make rational and clear decisions.
Okay, so are you more aggressive with your own money?
Yes, I am. I definitely am because we are limited in our portfolios at the firm just for compliance reasons to max 12.5% position sizes. And so we can't really size more than that just for risk management. So
Okay, so where do you want to go in your career from here?
right now, I want to help Revere build to a multi-billion-dollar asset management company. And when I joined with my friend, we're at about 100 million, and now 2 years later we're about 400 million. So I got my eyes on the 1 billion mark, and we're growing really fast. So that is where I'm seeing myself right now. Just continue to build my book, build clients, help them do well in the markets, especially manage risk when the market turns. And That's usually what gives me the most satisfaction when clients email me, text us saying that they can sleep well at night.
Okay, so what kind of clients do you attract? Because it does sound like you have a unique proposition, because not a lot of money managers are outright saying they're trend followers, they're using technical analysis.
Yes.
I think like everybody wants to seem like they're the typical Harvard MBA route. We're going to buy what is it, growth at a reasonable price, or
Yeah, value stocks. Yeah.
or I'm going to buy great stocks on sale. So
Yeah, exactly.
So what kind of customers say yes?
So I break our customers or clients down probably into two main categories. The first one is people who are with like Morgan Stanley, Goldman, JP Morgan, what else? Like let's say Vanguard, Merrill Lynch, and they've experienced the pains of riding through 25, 30, 40% drawdowns. They've experienced their managers not have any sell rules and tell them just to hold on for dear life anytime they question their methodology. And that is the first set of clients that come over, especially they realize that humans don't live forever, and especially in retirement where their income is cut off. They have to live on their nest egg. They can't be sustaining 30, 40% drawdowns for their mental health and their financial health. The second is that traders who understand and who have followed our Twitters and YouTube channel for a very, very long time. And a lot of times maybe they might be people who dabble in the markets that can't really get a performance themselves. So they also diversify their money to us. So most of our clients understand our process deeply from our YouTube videos, from what we post on X or Twitter. And I'd say those are the two main demographics.
That's awesome. It sounds like they're coming in. I mean, if they've been following you on Twitter, they're already on board. So that's awesome.
Exactly. Yeah.
Okay, so we are going to close out in a couple of minutes. If you've been enjoying the show, please like, comment, and subscribe. If you're listening on Spotify, make sure you hit the follow button. You could also leave comment down below on Spotify. Yes, Spotify has comments. So Ted, we're going to close out with a few rapid fire questions.
Okay.
What is your favorite Wall Street / trading movie?
It's just classic one, The Big Short.
Okay. What is your favorite breakfast food?
Eggs.
Okay. What is your
Scrambled eggs?
Scrambled eggs.
Scrambled
Okay.
eggs.
What is your favorite musical album?
Oh man, I don't think I have an album. I'll give you my genre. Like I like house, EDM. I like some pop as well.
Is there a favorite artist there?
Favorite artist? I like Avicii a lot. Mm-hmm. Too bad he died.
Yeah, very sad.
Yeah.
Your number one trading / investing book ever?
I'll say Market Wizards.
Okay. Who is your role model?
Stanley Druckenmiller.
Why him?
I just love how dynamic he is. He's able to play all four markets. I mean, everyone knows his track record, 30% CAGR for 30 years with 0 down years, and his ability to stay flexible and adaptable. He tells his famous story where he starts shorting internet stocks early. Of course, all those stocks eventually go to zero, but he gets squeezed out. And then he knows he shouldn't FOMO. He tells himself to not FOMO. And then he FOMOs literally the exact top of the dot-com bust by like 1 hour. And then a second story is that he was short into the 1987 crash. And for some reason, he started buying the markets the day before the crash. But of that day, when the markets gapped down, not only did he get out of his long, he went short and made a huge killing as well. So his flexibility, adaptability, and dynamic trading just makes me extremely impressed.
Okay. Final question. If I was to give you $1 million right now and you have to put it in one stock for the next 25 years and never sell it, what would it be?
25 years?
25 years.
Tesla, because I'm a big believer in Elon Musk.
Okay. All right. This is, by the way, our audience loves to argue about Tesla and Elon Musk. Do you think we're actually going to get robots anytime soon?
I'm not sure about anytime soon, but I could see in the next 5 to 10 years, we'll have a lot of robots helping us walk in the streets too.
Yeah, God, I wish I could just have like a robot to clean out my refrigerator and do the laundry. That would be a miracle.
But my Tesla answer, it's not necessarily only just investing in Tesla itself. It's really the only public way to invest in Elon Musk, and I'm just a big believer in Elon Musk. And that might be controversial nowadays in this environment, but that's my answer. I would want to invest in Elon Musk.
Yeah, you know, it's going to be crazy in like 10 or 15 years from now that like CEOs inspired by Elon Musk are going to be out there. Because I feel like he's kind of pushed the Overton window for CEOs.
Oh,
so
yeah, 100%.
I think like Alex Karp of Palantir might be the only other really interesting one. But I think over time, CEOs are going to get crazier and crazier.
Definitely. And I mean, that you can argue that could be a good thing, could be a bad thing, but I think everyone trying to pursue truth is the best way to go about it in civilization.
You got it, and it makes the world entertaining. Like if you're
Exactly.
if you're following the stock market, this is the best possible reality to be in. This is the best timeline.
It's the greatest TV show. It's the greatest game you can ever play. Like, why watch TV shows when you have the markets and geopolitics and economics to watch? It's always entertaining, week in and week out.
Endlessly entertaining. There's always new characters. There's always new drama. Somebody's always making trouble. So I love it too. Okay, everybody. I hope you enjoyed the show. I hope you love meeting Ted Zhang. There's going to be links to all his stuff down in the description below. Again, like, comment, and subscribe, and we'll see you soon.